Is the bottom in for U.S. equities, or will sky-high energy prices be a spoiler? Hi, everyone. Welcome to the Daily Briefing. I'm Maggie Lake, and here with me today is Katie Stockton of Fair Lead Strategies and Real Vision's global editor, Weston Nakamura. Great to see you both. We're gonna get Katie's thoughts on the direction for the S&P in just a bit, but Weston, I want to come to you first because we've been seeing this all over Twitter, and there's been a lot of traction and concern about this. What is going on with these rolling blackouts that we're seeing in China?
Yeah, so I'm glad you got right to the chase there. So first, let me just kind of give a background. This is not just China. This is happening globally. Wherever you are from where you're watching this, I'm sure that you have currently heat waves and extremely extended periods of very hot and dry weather and all that, and that is pushing up energy prices, gas prices. You're probably blasting your AC, and that's happening everywhere, right? So this is Bloomberg just today was reporting on 20 million, 1 in 6 American homes are behind on their energy bills, right? So that's hitting the U.S.
And
Obviously.
and by the way, we've seen Gary, thank you on Twitter, asking, "Well, hey, what about Germany?" Absolutely, Weston. It's everywhere. And we were talking in at our editorial meeting that we're seeing incredible pictures of that, right? Whether you're seeing 600-year Buddha statues coming out of dried up rivers in China or
Right.
Nazi warships surfacing in Germany. We've dinosaur prints in Texas. I mean, it does feel a little like end of the world type stuff, but it is
Yeah.
extreme in so many different places at the same
It,
time.
it's exactly right. So I mean, yeah, everyone's probably going to say like, what about insert my region, right? So the Rhine, like, exactly what as you mentioned, that's which basically runs. It's not just Germany; it's like Switzerland, North Sea. It's a very key waterway for a lot of goods to move.
Mm.
And that it's basically the river basically getting depleted. It was actually, I think, over the weekend it started to stabilize a little bit, but still very precarious situation. Japan is now resorting to a potential restarting of nuclear energy, which was a huge no-no after the Fukushima disaster and all that. And this is under Prime Minister Kishida, who comes from Hiroshima, atomic bomb Hiroshima, and so he's very sensitive to nuclear. But he's essentially going to be pushing for this. So that's kind of where we are. And
Yeah.
so amidst the backdrop of all that, what's happening in China right now is that you have again the same problem. You have a record amount of like extended, very hot conditions. But what's happening is that that's leading to not just huge energy demand, but it's leading to the same kind of sort of problems. You're getting like a lot of water sources to dry and dams to dry, and so you're really just having this huge massive power crunch that's going on, and that's leading to, this is not like a potential thing that's going to happen, that's currently happening right now. It's leading to factories to shut down, and that affects automobile manufacturing and the solar sector and all that. So this is not like Germany, is going to sometime, if this is a very cold winter, they're gonna have to decide between shutting down factory production, and that is happening currently in China. And the reason I really want to flag this is because what I'm assuming is that everybody who's watching this, like I said in the beginning, you're probably dealing with that, this very issue going on in wherever you are geographically. And so that's going to be your front page. And so you're not going to probably see this about what's happening in China right now, but this is yet another thing that's happening in China. This is in addition to, I'm not even getting into like COVID lockdowns or people not paying their, boycotting mortgages, or the PBOC that's trying to, cut policy rates, but they're not really being effective with it, and so on and so forth, and all these other sort of factors that are happening. So I just really want to flag that this is something that's already happening in place, and that's going to be showing up in macro data, coming forward.
Absolutely. And this is why I wanted to dive in on China, and I'm happy that you're flagging it for us because first of all, we know what happens with the supply chains. We've seen this before. When China has to go into lockdown, you're talking about huge cities. I mean, the idea looking at Shanghai dark, and as you said, some of the other industrial hubs going dark, but it is also coming at a super sensitive time because they are dealing with a weak people are guessing much weaker, and we're heading into the People's Party Congress. I mean, the worst time in many parts of the world, the worst time for this to be happening. But in China, it's a very politically sensitive time too, isn't it?
Yeah, and so therefore, given the structure of China's I mean society as a whole, a politically sensitive time means that it's an economically sensitive time, it's a socially sensitive time, it's a military sensitive time, and all of that too, right? So there was something that also wanted to flag too, and this is sort of I guess a kind of non-consensus thought, but so Nancy Pelosi, Taiwan, all that. That's last week's news, right? Who cares, right? Well, there's a view, albeit like probably not as not consensus, but something to consider is that what this Nancy Pelosi visit essentially might have triggered is that because there's so much, like a whole laundry list of disruptions that are happening in China socially and all that, and Xi Jinping really needs stability more than anything. And right now, there's just this whole confluence of stuff that's happening. What the Pelosi visit did was that it may have actually given him this sort of one area of strength where he can kind of cash in on that, and so it's possible that he might actually call the party congress earlier than people expect. People are expecting October, November is when it's going to happen, but if he's trying to lock in gains now, because the longer the time passes, things are going to just get worse and worse economically and all that. So if he's trying to lock in his gains, he could pull that forward into as early as September. We're days away from September, and so the party congress, like, well, let's put aside the debate of what may or may not come from that, if he flips on the zero COVID policy and all that and the implications. Let's just put like that aside for a second, and let's just look at the time frame in and of itself. That time frame, if that's shifted forward to September, that matters, and that's something that people are not braced for. Like, I don't think people are braced really for the party congress as it is, but they're certainly not braced for it to be shifted earlier. And the reason that matters to markets is because so Brian, if you pull up chart 2, so this is just an example, right? I just looked up on CME. This is open interest on crude oil, on WTI crude, going into the rest of this year. And if you take a look at this is just positioning, right? For December contracts, which expire in mid-November, there is a massive, massive open interest in call options. There's about 1.4 million call options to about 600,000 put options for that November expiry. Now, that could be for any number of reasons, but I suspect that there's a good chunk of that huge open interest that may very well be positioned for crude oil upside due to party congress happening, and then therefore Xi Jinping basically ditching this zero COVID policy that is becoming increasingly indefensible and all that. And then Brian, if you go to the following table 3, I believe, this is just the options sort of open interest matrix. And it's kind of hard to look at, but if you look at that like red box, right? So that's for December expiry. So these are contracts that are going to expire in November, mid-November, right? And so if you look at that, these are like strike prices that are below current, and you'll see that there's like in the mid-teens or so of open interest in certain strike levels. In the like be it from, call it 50 all the way from 100 all the way down to 50, and it's like 11,000, 12,000 contracts, whatever it is, right? Then if you go to the next one though, the next chart, Brian, this is just a snapshot I took of, and I kind of just like sliced in a bunch of pieces of this because it's not going to really fit on this screen. But what you're looking at are massive options open interest at like ridiculous strike prices. So we're looking at, basically, I'm just kind of eyeball skimming this, about a $250 billion notional outstanding in calls for the above a 100 strike for expiry in mid-November on WTI crude. You're looking at 40,000 contracts at 150 crude. There's 20,000 open interest at $200 strike. Another 20,000 at 250 strike. I mean, there are huge positions that are opened, and at that level, that's not really hedging either. That's kind of speculation. But what matters is, once again, is the expiry, is the timing of that. And if that is, if those are positions that are established with the expectation of a October or November party Congress, and the party Congress suddenly gets pulled forward to September because Xi Jinping decides to, you know, to pull forward to lock in his gains. I mean, we're looking at, like I said, just in those strikes alone that are out of the money, it's a $250 billion notional worth of crude that is not necessarily mispriced, but it's mispositioned in terms of expiry. And so that's just one random, like, sort of, market positioning that will need to shift suddenly and create a ton of immediate term volatility should that headline exist. So I just want to throw that out there. It might not happen, but if it does happen, I don't want people to be completely thrown off guard and just to consider that as, a potential tail risk.
Right. So, Weston, this is what we count on you for, is to be kind of paying close attention to the parts of the market that people aren't watching. And if you are at all playing in crude, then you need to pay attention to that. And even if you're not, you need to know that something like that can come in, um, hit people unexpectedly, and then you've got a lot of volatility, and then you have people who have to make up for the fact that they were mispositioned. So that kind of volatility can spill into other markets. So if you're listening and you think, well, I'm not in options and I'm not in crude, this won't affect me, that's not true. This is why Weston's pointing this out. One more thing I want to ask you about then is the yuan before we skate here. So you put a tweet out that made us laugh. It was, experts are sure the RMB won't have a meltdown. And you were like, thank you very much, Chinese state media, for making us all feel much better. But we did see the yuan hit a 23-month low Monday. Are you watching that at all? I think you've been watching it in terms of the correlation with other assets, right?
Right. Yeah. So I went over this with Andreas on Monday. The reason I want to reiterate this is because I thought I was pretty clear, but I'm just going to be as absolutely clear as possible. So, Brian, can you bring up the first chart, please? The reason that you should care about the yuan, the equity investor in the United States, whoever it may be,
the Chinese currency,
but yeah, of USD CNY, which I've inverted on this chart. So therefore, if that red line going down is the yuan going down, and vice versa. The recent top in this, like, if you want to call it a bear market rally or whatever it is, that was marked by the yuan that had pierced through the 6.8 level and gone higher. And I just want to show very clearly that top chart right there, that's E-minis, that's S&P 500 index futures, and the Chinese yuan and US dollar cross rate. And they are very much moving in lockstep. Now, they don't always move in lockstep, and so the bottom chart is showing that sometimes it does, sometimes it does not. When it does make very sharp moves to the downside, as you can see in between those two lines, that's April 20th to May 15th. You can see that does drag down risk assets, including E-minis. And then for a period, they were not correlated. And currently, they are recorrelated back down to the downside. And again, this is a managed currency. This is China allowing this to happen. And apparently, they're allowing this to happen under these conditions of, like I mentioned, these these droughts and zero COVID policy, mortgage boycotts, all of that stuff, right? So if it's going to be a continued yuan weakness and they're allowing it to get to somewhere like, 7 handle even on USD CNY, then that's going to be sharp, and if it continues to correlate with SPX E-minis, with Bitcoin, with the Nikkei, with the DAX, whatever, it's going to pull down risk assets from where they had just been, sort of rallying to. So this is why I'm flagging this. I'm not flagging this for the fact that people are exposed to the yuan or anything like that. I'm flagging it because apparently markets are currently watching China and are trading off of that. The yuan in and of itself is not moving SPX or anything like that. That is just a reflection, again, of what is happening with China and with their managed currency. And so risk assets are moving in tandem with what's going on in China. That's why I'm flagging it.
We got a lot of good stuff to pay attention to. And as always, a lot of this is not on our radar, as you said, because so full up with what's going on and everything we have to watch on this side, Weston. So totally appreciate you. Thank you so much. And Weston, of course, is going to be, we're all going to be watching. He's going to be all over everything that's happening in Jackson Hole too. So we looking forward to your tweets on that. And Weston, if you could, anybody interested in those charts, Weston probably can tweet them out, so you can get a closer look at them. Thank you, Weston.
Thanks so much.
All right, Katie, let's pick up this conversation, and bring you in now and dive into some of the charts that you're looking at. In particular, it would be great to see what you think of the S&P, because this is what a lot of the people, especially sort of those who are in the equity market, a lot of people stateside, are looking at. We had this what looked like a comeback. Everyone's wondering about this rally in equities. Was it a bear market? Is it going to turn? Is the bottom in? So as you look at the technicals you follow, what does it look like for the S&P? Has this rally run out of steam? Is there some, risk to the downside here?
I think yes and yes. It certainly has run out of steam in terms of short-term upside momentum, and we were viewing it all along as a counter trend move within the context of the long-term downtrend that was established earlier this year. The daily chart of the S&P 500 that you see on your screen shows that loss of momentum. So if you look, there's a daily MACD indicator. It's a short-term momentum gauge, very popular amongst technicians. It has flipped to a sell signal, and amazingly, it occurred right after resistance was discovered. So we think there is, of course, some risk to the downside with the downtrend still having hold technically. Even if we were to see the S&P 500 sort of inch above that 200-day moving average, it wouldn't change things for us. And we say that because the long-term setup really still is very challenged. If you look at the longer-term indicators, this is a monthly bar chart of the S&P 500. You'll see in the bottom window that momentum is still very much to the downside long-term. And the first oversold reading that we have here as of June usually isn't the last oversold reading for the end of a bear market cycle. If you go back to 2008 to 2009 or 2000 to 2002, those periods saw retests after retests of that oversold territory. So it really is a process that we're looking for in order for the market to establish a bottom. I think the hope that there is some kind of V bottom already in place is really just that hope, because that's what we became accustomed to during corrective phases. But indeed, we think that this is something more than that.
So does it look likely that we do retest the lows for the S&P?
The support we're watching is actually derived from a Fibonacci retracement level. There's interim support around the 50-day moving average. But if you can see this line here, it's about 38.15, and it's a Fibonacci retracement derived from the uptrend drawn from the COVID corrective low, which is in hindsight a very important low for the market. Now, if that level is broken, then we feel that there is really significant downside risk being to about 3,200, which is a secondary Fibonacci retracement level. So we would not rule that out as part of this scenario, but 38.15 is the key support in our work, and we do expect it to ultimately be retested. And then it's just a matter of acknowledging time horizons and trying to manage risk over various time horizons. If we drill into some of our short-term work, we're seeing, not for the S&P 500, but some of the higher growth areas of the market, short-term oversold conditions have returned, and that could get us a little bit of a bounce in the coming days. Maybe it's something in the Fed comments that folks receive well, but that to us would be a selling opportunity for the reasons laid out here on the longer-term view of the S&P 500. We want to use these relief rallies, which we see as bear market relief rallies, as opportunities to reduce exposure to avoid that next downdraft.
That's so interesting. And, I should point out, for those who are listening, if some of the terms seem unfamiliar that Katie's talking about or talking around that are often used in technical analysis, there's an entire segment on the Academy where you can kind of dive into that. But especially at times right now where there's a lot of disagreement, where people, have really wide opinions on the spectrum of what might happen. You've got some active managers sort of out of the market right now on the sidelines as they, A, wait and see what happens, and B, some of them are just off because it's August, trying to, recoup before we head into what is going to be a really busy fall. These are the times when people really rely on technicals, and they like to sort of check their narrative against what they're seeing on the technical front. That's what Katie does for them. So, it's kind of important to pay attention to this part of the market too, and it's important sometimes to stop and sort of from the fundamental conversation, take a look and see if it's matching up on the technical side. So interesting to hear what you say about risk assets based on just rolling off of Weston, who was looking at things like the yuan that have been correlated in the past, weighing on it. Energy, as we said at the very top, this is the other concern. All these energy sort of crises coming together at the same time going to be really problematic for the economy and put pressure on risk assets? That's a fundamental side of the conversation on stocks. But on the energy side, Katie, so what are you looking at there? If we have, or if we're seeing this sort of upward momentum and pressure potential for another leg up, do you see that reflected in the technicals for, say, oil, for WTI?
We do. And, in our search for long-term uptrends in a bear market cycle, sometimes it's somewhat fruitless, and yet we can find those long-term uptrends in the energy sector. And of course, that's really a derivation of commodity prices. Crude oil has been in a corrective phase up until very recently. In fact, this week, we saw a bit of an improvement in short-term momentum there. But also natural gas prices are trending very strongly higher. And those trends, we want to assume they will keep hold. I'll show you on the crude oil chart, this is a generic future here. And forgive me for getting technical, but it's hard not to as a technical analyst.
Yeah, no, that's what we want from you in this conversation.
With the corrective phase, we have what we call an oversold upturn or buy signal in our indicators. And it's really twofold. So based on two of our different indicators, and it's occurring near some support. If you just look at the shaded area, this is called the cloud model. It's a support level that applies very well to commodities typically. So we're looking for the relief rally here for crude oil to persist. With that, we're looking for more momentum behind that energy sector, of course, and relative strength there too. So it is one place to find long-term uptrends. There are actually some indications on the monthly chart of crude oil that the uptrend may tire out a little bit for maybe something close to 9 months. It's based on something called the DeMark indicators, but it's a bit premature, we think, to position for that. Rather, what it suggests is that it might be difficult for the highs from this springtime to be surmounted. So maybe a lower high will be established and something different unfolds. But as it stands, it looks higher, and the long-term uptrend is very much intact there.
Yeah, and this relates back to a lot of what we're talking about in terms of, how do you fund or how do you support the transition, even if you're in a green energy transition, the realization that fossil fuels may play a role in that. We're talking about if they pull up the People's Party Congress and China does get rid of its zero COVID policy after that, which is some of the speculation. Do you see that economy open up, and does that put pressure on oil? So those are some of the fundamental issues, lack of investment that a lot of the analysts that come on are talking about. And on the screen, you're seeing, Katie's technicals also sort of reflecting some of that. Doesn't mean it's going to happen, but those are the kind of lining up several different narratives that come together, both fundamental and technical, are what a lot of people are trying to sort of search for right now. So, Katie, if that's the case for oil, does that mean the energy equities outperform the rest of the equities? Because we've kind of established that we might be in this downtrend, maybe headed to retest the lows or near them for the S&P, but then is energy the outperformer in that?
Well, it certainly has been. In fact, I'll show you a ratio of XLE, or the energy spider here, to the S&P 500. You see an uptrend this year that's really been pronounced, a corrective phase certainly, but it seems to be advancing from that correction. So we're assuming that this uptrend will maintain itself, obviously, until we start to see any of those longer term signs of exhaustion manifest themselves in our momentum gauges. And we want to just stay with what's working in this environment. Really, the only two long-term uptrends left out there are in the energy sector and in the utility sector as it pertains to U.S. equities. So as you know, we launched an ETF not too long ago. The ticker is TACK, and it has exposure to only the energy and utility sectors in addition to risk off asset classes, short-term treasuries, long-term treasuries, and gold.
Mm.
So that kind of sort of more bearish positioning is something that we're comfortable with, just noting that that long-term momentum is still to the downside and just looking for anything that has that relative strength behind it, and which, as you suggest, is really behind energy, and then perhaps to a lesser degree the defensive sectors of the market.
I want to take a look at the U.S. dollar. This has been a huge topic of conversation. We saw a little even sort of flattening or taking a break, but it's just been relentless. And some of the moves have been huge. Ash Bennington spoke with Michael Howell recently about his views on the U.S. dollar. Let's take a listen to a clip from that.
Dollar, I think there's two ways to look at the dollar. One is the use of the dollar, and secondly is the level of the dollar. Is the dollar going to be eclipsed by a Chinese yuan, international yuan? No way. Not certainly in the short to medium term. In the long term, it's anyone's guess, but I think the dollar is absolutely dominant right now. And I think the dollar gets stronger. I think it gets stronger because we've seen that currencies like the yen or the euro are actually underlying flaky. I think the euro has got to devalue a lot more than it has already. And if you look at the companion move in the yen, and the euro is clearly an alternative to the yen in international markets in terms of trade, you're really looking at another 10 to 15% down, I think, in the euro. So I think that they're going to struggle, particularly with the huge debt problems they've got in the eurozone. So I think that from that perspective, what you've got is dollar dominance in terms of use. I think in terms of price, I would expect the dollar after this big rally to have something of a sideways move. But I still think the dollar has got the scope in the medium term to move upwards, really because, where else does one go in the world for safe assets? The US has almost got the monopoly on those right now.
And that full interview is available on our website. So hard for Michael to see the dollar backing down anytime soon. Katie, what are you seeing on the charts?
It's another one of those long-term uptrends, right? And it does still have long-term upside momentum that shows no signs of relenting as of yet. This is a weekly bar chart that we have on the screen. You can even just see in the curvature of the moving averages here, still pointing higher, still diverging, and with another little momentum upturn in the bottom window there. That is supportive of upside follow through. We've been watching a sort of a minor long-term resistance level for the dollar index just above 109, and we're basically back at it, retesting that level. It's based on another long-term Fibonacci retracement level. But if you drill out, or zoom out, I guess I should say, if you zoom out, you can see on the dollar index chart that there was a major sort of range breakout that preceded even this extension higher. And this major range breakout does target 121 for the dollar index over the very long term. So it's really something that we would see any consolidation as probably a pause to refresh this uptrend. 121 seems aggressive to us, but it's really where the next resistance level that seems to hold long-term relevance would be based on this breakout.
And Katie, what about bonds? We have a question from Brett on Twitter. Could the 10-year yield be at 4% soon? That seems pretty high based on a lot of the forecasts out there, and would seem to indicate from a fundamental point of view a lot more Fed tightening or aggressiveness than right now seems to be factored in. But what are you seeing? What's possible based on what you're seeing?
Yeah, I certainly would expect 4% to become realistic for next year, perhaps not before year end though. And it seems high, and I think just because it has a 4 handle perhaps. But in reality, we've seen what 10-year yields are capable of. You can see this uptrend very, very steep with a consolidation phase underway. If we see the 3.25 level, which is highlighted here as resistance around the 2018 high, if that level's broken, and for that we would usually look for a couple of good weekly closes above it, the next resistance is indeed 4%. So that 4% hurdle, it's a round number, it's a previous resistance level, and it would be a natural sort of place for 10-year yields to gravitate if we do see a breakout. So I think it is realistic, more likely for next year sometime. And in the interim, we're looking for more backing and filling. So up and down until this consolidation phase matures, allowing the longer term uptrend to resume.
Fantastic. And let's squeeze one quickie in on gold. You mentioned it was part of the ETF. It's been really frustrating for people. A lot of questions still trickle in. Should this be something that's part of my portfolio? But, it's been hard because it just hasn't performed in the way people thought it might. What's it look like from a technical perspective?
Yeah, regarding gold prices, I mean, they have seen sort of a negative momentum considering they're a safe haven asset class, and yet at the same time, overall year to date, we have seen gold manage to outperform the S&P 500. You can see that in this ratio. If you look at the curvature of the yellow line, that's the 200-day moving average. We are looking for gold to outperform in a weaker equity market. So we're looking for outperformance, and yet the momentum really just isn't there to the upside as of yet. Gold is in a long-term trading range, and within that range, there's very, very strong support of roughly about 16.75 per ounce. So we're looking for this so-called retest as the dollar, of course, challenges resistance to actually lead to some stabilization and ultimately another up move for gold within its longer-term trading range. But indeed, the momentum has been a big challenge there.
Fantastic. Katie, such great signposts for people to really be paying attention to in some of the levels as we enter what is sure to be a really, really volatile, we hope not challenging, but certainly action-packed fall. So thank you so much. Great to catch up with you.
You too, Maggie. Take care.
Thanks so much. Thanks for the great questions. Andreas Stena-Larsen is going to be here tomorrow with Tony Greer. So be sure to join us once again for that. In the meantime, take care and good luck out there.